and welcome to Market Domination. I'm back, baby. Julie Hyman alongside Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
But right now, the economy is a bit on trial with most of the focus on the labor market. That's going to be the headline event, a drum roll into that Friday morning print, and really going to set the tone for the September rate cuts, whether that's 25 or 50 basis points. I think if we see anything weaker than expected, expect a 50 basis point rate cut. I don't think the market's going to welcome that news, as it did not back in early August. So it's going to be a short but a pretty wild week, I think.
I actually think the JOLTS report is the more important report coming out tomorrow. It tells us hiring. It tells us that labor differential, which is actually at a 3-year low. That's a proxy for unemployment, and it looks like unemployment could be moving higher. So I think there's a lot of uncertainties that we'd get a soft landing. I'm not saying we go full-on recession.
Boeing has major issues in that they don't have any product in the future. They got the 737-10, which still hasn't been certificated. After that, they have got nothing in that area. And by 2030, they're going to be way behind the curve in terms of being a global manufacturer. I hate to say that, but that's why they were just re-rated again just the other day.
We got 1 hour to go until the market close, so let's take a look at the major averages here. All three major averages having their worst percentage declines going back to August 5th. August 5th, of course, was when we had the jobs report that really put some fear into the market. We clawed back from that level, and now we're down again today.
Historically, September, Julie, we know, not usually great to be long the market, not usually great to be a bull, and we're certainly kicking off things like that. Now, you have read across the screen right now some points of focus that I think are interesting today. The chips, names like Nvidia getting absolutely whacked today. I see different kind of analysis of why that could be. Is that traders, investors still trying to work through and make sense of that earnings report? Is that just Nvidia maybe getting caught up in a broader rotation? But that's having an effect if you look at Nvidia. Intel also taking it on the chin, the SMH in general. Of course, we always watch chips because even if you're not in chips directly, chips do tend to lead the market on the way up and on the way down.
Yeah, Nvidia's been falling pretty much ever since it came out with its earnings last week. That beat expectations, but not the blowout, absolute blowout that some investors
clearly wanted more.
Have come to expect. Exactly. The stock, by the way, is still the best performer in the S&P this year, even with that big decline it has seen. To your point, other chip stocks also down today. By the way, we do get Broadcom reporting this week after the close on Thursday. It's one of the stocks that's down today. We did get some monthly numbers from the Semiconductor Industry Association for July, and some analysts said those numbers were a little below seasonal trends. That might be, to some extent, contributing to some of the selling here today, perhaps, but it also seems like it's just sort of a vibe shift that we've seen.
Yeah, and also,
stocks.
Julie, of course, we're looking ahead to Friday. You got the big jobs report where investors have already, they're already shifting from inflation to just the overall health of the economy. We did get U.S. manufacturing activity today, shrank in August. So is that, maybe reviving some growth concerns as well? Maybe you're seeing that show up too.
Right, and later this hour, we're going to talk to a Citi economist who says that jobs report on Friday is going to be weaker than the market expects and could lead to the Fed cutting by half a point
Soft
next
enough
week.
to maybe justify a supersized 50.
That isn't the majority view. It doesn't seem right now, but we are going to get that view, and it is an interesting one. Let's also talk about what's going on with oil prices, shall we? Because we've got a tough day in the oil market with crude prices sliding on renewed concerns about energy demand from China. Now, both Brent and WTI have actually erased their gains for the year. WTI settling at its lowest level since December 12th. Joining us now is Dan Dicker, the Energy Word founder. Dan, always a pleasure to see you. So just give us sort of broad strokes. What is behind this latest leg downward in oil prices?
It's been exactly what you said. There's been, for the most part, Julie, there's been a lack of demand and supply that keeps on coming onto the market, despite the fact that rig counts keep going down domestically. The production in the United States continues to rise. And OPEC Plus has gotten tired of cutting production for the marketplace. And now there have been promising increases in production that are supposed to start next month. and there's no indication that they're going to back away from those. So more oil coming in. Again, the end of the Labor Day weekend, and it didn't seem like demand was very big. Gas prices are lowest that they've been in 3 years. Just in general, there's been a commodity kind of glut out there, and oil has been leading the way down.
Let me ask you, Dan, we talk on the demand side, we talk about weakness in China, and obviously for good reason. I'm just curious, what is the demand picture like here in the U.S.?
Again, the same thing. We're not seeing anywhere near the kind of demand growth here in the United States that would offset the kind of supply increases that we've been seeing, both domestically in the United States and globally with OPEC plus. Again, this is not unusual for any of the commodities. I mean, you can see copper, lithium, iron. I mean, everything is in the commodity space is going down while the stock market has been going up. And it's really one of those moments. It's very rare. The last time we saw commodities beaten up this badly was right before the pandemic in 2019, and before that in 2015. So not very often that we see this kind of disconnect between commodity prices and stock prices. In general, from a trader's point of view, they're usually wrong when they get this pessimistic about commodities, but I guess that's another story. For today, bad news for commodities all across the board.
Well, I guess, will this go beyond today is the big question now, right? We even talked about China, but China demand remains maybe not what the market was hoping for. These other dynamics you're talking about on the supply and demand side, is there going to be any change in those dynamics in the coming weeks?
Look, it takes a while for these gluts to clear themselves, Julie, and they're there. They're real gluts. But I do see, like I say, I see two kind of very important symbols of when this market might turn around. Number one, obviously, is the Fed and their ability to lower rates, and how far they will go over the next couple of months to lower rates does inspire the kind of investment that these kind of commodities need to generate a little more demand. That's number one. Number two is the traders themselves. I'm a big believer that when all the traders get on one side of a trade, it's normally wrong. And they are as short as they've ever been in the commodity basket, like I say, since before 2019. And usually when they get this deeply on one side of a trade, the market has a tendency to bounce the other way, and pretty hard. So I've been talking to some of my subscribers and telling them it may be time to wade in, get a little bit of the copper miners, get a little bit of the oil companies that are cheapest, get a little bit of lithium and cobalt, some rare earths that have really gotten beaten up. And, you might have to sit on it for a little bit, but they're pretty cheap right now, and they represent some decent value.
Dan, back to oil on the supply side, there were some headlines today, Dan, that talked about maybe an end to this dispute that halted Libyan production. How big a deal is that?
Not very much. I mean, again, we're talking Libyan production is under 1 million barrels a day. And in the global, effect of 106, 107 million barrels a day, the things that we're really looking at is what Saudi Arabia is going to do with their spare capacity, what the United States is doing with their spare capacity, and what the Russians are doing with their spare capacity. So on the margins, it might matter if we were at a place where the balance was really kind of paper thin. It's not. There's a lot more supply out there than there is demand, and you've kind of seen it in this slow kind of bleed away of prices of oil over the course of 2024, basically the entire year. And
it sounds like from what you're saying that the glut is going to be maybe slow to reverse as well, or kind of it happens gradually. But are there any sort of upcoming catalysts, either to the up or downside, that investors should be watching for?
It's not what you see beforehand. It's sort of like the positioning you do as a trader, kind of, Julie. I don't know what the turnaround is going to be, but like I say, these signals that I see that could spur a change in the demand picture. Definitely the Fed lowering interest rates has a big impact on that kind of investment into new production that moves prices higher. So it's not something that happens overnight. It's a slow train. It's turning around, an aircraft carrier in a canal. But when it turns around and it starts to move, you're best to be in it beforehand, because you don't generally catch it on the way up.
Dan, let's end here with what you see with gas prices in the near to kind of intermediate term here. Prices at the pump, Dan, when you're talking to your subscribers, they asked you, bring out the crystal ball. What do you tell them?
No, I think we're pretty much there. I mean, another 20, 30 cents in gasoline. Maybe we'll slip slightly under $3 a gallon. That would be really nice. I mean, for a lot of people who are driving. I don't know. There's a limit now to how low oil can go. I think those days of seeing $2 gasoline are completely over. Of course, you never say never in this world, but I think those days are kind of over. Again, once these markets get to a point where folks have to shut down supply because they just don't make a profit by pumping it, that's when you see those turnarounds. And you're getting really close. I don't see prices of oil going, into the 50s for sure. And mid 60s, I would really start to be looking at oil companies to buy just for the fact that it just gets too cheap to believe.
Dan, great to have you on the show. Thanks for helping us kick it off. Appreciate it. Stocks are sinking here, and the selling is accelerating into the closing bell with stocks trading near the lows of the day. Let's bring in Keith Gangle, Gradient Investments Portfolio Manager. Keith, it is good to see you. Listen, we know, Keith, historically, September is tough to be long this market. I'm just curious what you make of today's trade, what explains the sell-off we're seeing, Keith, and what do you see ahead?
Yeah, we take a step back and take the whole year, for example. We're up 19.5% going into today. So seeing a sell-off, yes, 2% is a lot. But again, we're up 19.5%. Last year's up 25%. The thing I don't see a real catalyst for the sell-off here. So I think it's probably a little bit of profit taking going on here right now. But we'll wait and see. Obviously, we saw Nvidia was a big data point last week. We got the jobs report, I think, is going to be the driver this week. So I think that everybody just needs to take a deep breath and kind of watch what's going on.
Keith, you mentioned, of course, that this is being led downward by Nvidia, a lot of the big tech trade. And there was an interesting chart that Kevin Gordon of Schwab pointed out recently, which is that we've seen this underperformance now on a monthly basis of the Magnificent Seven. Basically, for 2 years, the Mag 7 have outperformed the S&P 500 on a monthly basis. That has changed the past 2 months, where last month, the S&P was up, the Mag 7 total return index was down. So we've all been waiting, right, for these other 493 stocks to recover. It now seems to be happening. But how long can that be sustained? How long can an overall S&P 500 performance be sustained without the participation of the Mag 7?
Oh, yeah, look at it again. As of year-to-date performance, as of last week, Friday, we're up 19.5%. And you just pointed out the last 2 months, the Mag 7 actually underperformed, and the market's, almost all-time high here. So they can do it. Obviously, we don't like to see the Mag 7 massively underperform, but I think it's wise for people to take a little bit of profits out of their Mag 7 and kind of put in other companies. And I think that's exactly what's going on with the market. And again, they're such a big market cap. They're about 30-some% of the overall S&P 500. So we want those names to perform, but I do think it's wise to take a little bit off, maybe go underweight if that's your benchmark, and kind of put those names in otherwhere.
Keith, I'm interested too. There was a good piece of the Journal today. I don't know if you saw it. And the headline was interesting, Keith. It said, Americans are really, really bullish on stocks. And points out, Keith, in the piece, one measure of bullish sentiment among investors hovering around its highest levels of the past year. I'm just curious, Keith, when you see stories like that, when you see sentiment indicators like that, does that get you concerned at all, just as a contrarian take?
Yeah, it sure does. It's one of those things, again, market's strong last year, strong this year. You're starting to see people starting to chase performance. We advocate against not doing that. You should have a risk tolerance of your overall plan. So if you were a 60-40 client, 60% equity, 40% bonds, after the last year and a half move, we advocate to rebalance down. Maybe you're at 75% equities. You need to move that back down to 60. Again, it's normal for the markets to pull back. I mean, we'd like to go up straight 7-8% a year, but it doesn't work that way.
And I know one of the areas you're looking at is consumer, right? And Keith, we've gotten a lot of those consumer names reporting over the past couple of weeks. It was a pretty mixed bag, it seemed like, overall. What sort of characteristics are you looking for within those consumer stocks?
Yeah, you're exactly right. Some of these consumer names haven't been that great, but the area we tend to focus on is areas that provide value. Think of your Walmart. These are things that you need to go to the store. They had a great quarter, a great comp. Stock's done very well. It's not a cheap stock, but we think that continues to grow higher. Another one in that same kind of vein is Costco. Costco is a great performer. Again, not a cheap stock, but it's a compound grower. Those are the kind of names that we like to invest in. And the third name in that kind of same kind of category would be Target. Now, they haven't performed the last couple of years, but we think that's an opportunity to invest in a company that's kind of turning things around. This last quarter, they actually put up a good quarter. They did a 2% comp. Now, just to put that in reference points, Walmart did a 4% comp. But expectations were for a negative comp. So that's actually a good thing. I think Target's a good place of, looking at adding to your portfolio as well.
What about Amazon, Keith? Because that's another name I know you like. Is that a play on the consumer? Is it a play on AWS? Both?
Yeah, that's one of our favorite names. We talked about the Magnificent Seven not kind of performing the last couple of months. One of those names has been Amazon. It's kind of in the middle of the pack. We like this name for both reasons that you just mentioned. They have AWS, which is the technology side of things. They're growing last quarter. They just reported a great quarter on the AWS side of things. They did a 19% growth number. Put that in perspective, if you go back a couple of quarters, it was high single digits. So they're re-accelerating. That's the kind of company we want to be invested in. And the other half of the business, like we talked about, is consumer. They provide value. They're an online leader in online shopping. So that's the kind of name we want to invest in.
Keith, thanks so much. Appreciate it.
Thank you.
We're just getting started here on market domination. Coming up, Citi expecting Friday's jobs data to prompt a 50 basis point cut at the FOMC meeting later this month. We're going to be joined by Citi's chief U.S. economist later in the hour to explain. And shares of Nvidia sinking today. How should you be positioned, not just in that, but in the chip sector overall? We'll tell you how in today's Investor Playbook. Stick around, much more market domination still to come.
Copper is no longer a buy. That's according to the Goldman Sachs team. The firm is now expecting copper to hit an average price of $10,100 per ton by year end. That's below its previous expectation of $15,000. That news is dragging down mining stocks. And for more on metals, we're bringing in Yahoo Finance senior markets reporter Inez Ferre. Inez.
Hey, Josh. Yeah, as you just mentioned, Goldman Sachs basically lowering their price target on copper. And if you just take a look at the charts right now, we are seeing copper that's it's near the lows of the session right now, down almost 3%. A year-to-date chart will show you that you still have copper up more than 5%, but it was really in May when copper really peaked, when we saw those all-time high copper prices, and there was a lot of talk about that higher demand, utilities upgrading their grids. But since then, copper has been on a decline. And then just taking a look at what's been happening with gold prices, since gold prices recently reached highs in August, you're looking at gold that hasn't moved that much today. So if you take a look at the bigger picture, and if you look at the markets that have declined overall, you are seeing that copper has declined over the last couple of sessions, but not that much. You're only looking at it down 0.1%. And Goldman Sachs also in a note said, go for gold, basically saying that the commodity where they see the highest confidence in near-term upside is in gold, with Goldman maintaining its 2,700 price target on gold per ounce by early 2025, and basically saying that central banks buying gold. You'll recall that in Q1, central banks bought a record amount of gold for Q1. Also, Westerners getting into the game with inflows going into gold-backed ETFs. First, you saw that in Europe. Now we're seeing it here in the U.S. and North America as investors expect a reduction in rates at the Fed meeting this month. The catalyst for what's next for gold, analysts are saying, is going to be that Fed meeting, whether it's going to be a 50 basis point cut, a 25 basis point cut, and of course a jobs report this Friday, which could determine that, guys.
Lots to look ahead to. Thanks so much, Ines. Appreciate it.
Thank you.
Time now for some of the day's trending tickers. Let's look at Constellation Brands. That company slashing its full-year outlook. The company expecting a loss of up to $2.5 billion related to its wines and spirits business. That's a write-down. Specifically, its beer business also expecting to see softer sales, but holding up better than wine and spirits. And notably here, the company cut its sales forecast. It announced that write-down for its wine and spirits business of $1.5 to $2.5 billion. But it also raised the lower end of its earnings per share forecast. And that, among other things, seems to be reassuring investors.
I did see analysts at Citi as well citing reports as noting that the street basically expected that the company was indeed going to lower its annual sales forecast for its beer business and flag weakness in wine and spirits. So maybe some of this was just baked in. Citi saying, the street saw it coming. Company now sees net sales +4 to +6, had seen +6 to +7. Stock year to date, Julie, has done not much. We're up about 2%. But despite that, or maybe because of it, street loves this name. A lot of love.
Yeah,
for
a lot of love. How many buys we got
More
on
than
that
90%.
Wow, that is a lot.
Nvidia-like.
And I will say, by the way, that the beer volumes are expected to grow this year in the mid-single-digit volume range. So they're not seeing a decline in volumes for beer for the full year.
Yep. All right, move on. Check out this name. Automaker Polestar selects former Stellantis executive as its new chief financial officer. Shares, yikes, plunging today, down almost 14%.
No, they're up today.
Oh, I'm sorry, up today, 14%. Thank you, Julie. See, it's good to have you back. Green means up. Appoints a new CFO, Jean-Francois Mady. This is effective October 21st, so some changes in the C-suite. Most recently came over from Stellantis, was Senior VP of Global Accounting Operations and Finance Transformation over there. And by the way, this coming after the EV maker just recently did report results.
Yeah, and it also said that its CEO is going to be leaving too, Thomas Engelnath. He said last week that he's going to be leaving as of October 1st. So now this sort of rounding out the new C-suite for Polestar. But as we're showing, the stock has really struggled this year, along with a lot of the other EV makers, particularly the higher-end EV makers like a Polestar. So, we'll see whether this change, while it causes this bump today, whether it will be longer lasting. October 21st is when Mr. Mady, however we're...
I think I like how you said it. Even if it's not right,
whenever
I
he's
just like that tone.
taking over as CFO. All right, let's also look at CleanSpark. That company out with a Bitcoin mining update on the monthly basis. The company mining fewer Bitcoin in August compared to July, and the CEO noting CleanSpark is working diligently to optimize fleet efficiency and increase hash rate, perhaps more importantly here, the company said it's also going to double its authorized shares for issuance. So, simple law of supply and demand, when you have a certain number of shares and all of a sudden you double the number of shares, then that dilutes the value for existing shareholders. So there's some concern if they're going to be increasing their share issuance, maybe that would have a bad effect.
So what do bulls say on a day like this? I always like to check in with them. I checked in with a team at Cantor Fitzgerald. Bottom line, they told their clients they are not shaken, Julie. They maintain the outperform. The overweight rating, the target remains 23. Bottom line, they told their clients, we continue to believe that Bitcoin is setting up for a big run, Julie, which coincides with historical Bitcoin seasonality, and that CLSK is an attractive way to play Bitcoin.
Here's one problem with that thesis, at least this year. Bitcoin's up this year, like almost 40%. CleanSpark is down this year, about 18%.
I think, you know what, you just set up a guest. I think you got to get the analyst on.
I think we got to
explain the thesis to Julie Hyman. Coming up, Citi is expecting the July jobs report to prompt a 50 basis point cut later this month. We're joined by Citi's chief U.S. economist to discuss their outlook right on the other side.
While the Federal Reserve is more confident that inflation is slowing to its target, the central bank is still keeping an eye on the risk of further weakening in labor market conditions. The upcoming employment report this week will be the last one before the Fed's interest rate decision at its September meeting. And Citi is projecting that August jobs report could be soft enough for a 50 basis point rate cut from the Fed. For more on this, we've got the guy behind that call, Citi Chief U.S. Economist Andrew Hollenhorst. Thanks for being here, Andrew.
Yeah, my pleasure.
It. So it is really interesting here that we have now seen all the attention shift to jobs from inflation. And we've heard a lot of interpretations of the July jobs data that maybe there were things that were pushing it around, lower weather, for example, that mean that September's going to be better. But I guess you're not entirely a buyer of that opinion.
I'm not in that camp, and it has been a very quick shift away from inflation and towards the labor market. And I think it's appropriate because we do see the inflation data coming in softer, slower, and we see the labor market where we have a number of signs of softening. It wasn't just that July jobs report. Now, on the July jobs report itself, and now we're looking to where the August number is going to come out on Friday, I am skeptical of these stories about weather effects and temporary layoffs.
How come, Andrew?
And
why the skepticism?
it's really reminiscent of what we did with inflation. Remember when we talked about transitory inflation and it was just used cars, and every month there was a new story for why you shouldn't take it seriously. And this feels a lot like that because the unemployment rate didn't just move up in July. It's been moving up for the better part of 6 months or longer now, and it's been consistently moving up in each of the last 4 employment reports. So wherever the number comes out on Friday, in any given month, right, we can have factors that shift things around. Wherever the number comes out on Friday, we still have a range of data that tell us that this is a labor market that's weakening. So yeah, not a big buyer of the weather effect story. You can ask the Bureau of Labor Statistics that puts this data together, and they did put a note in that data release saying no discernible effect of Hurricane Beryl. So you're really kind of, saying that the Bureau of Labor Statistics isn't putting these numbers together correctly if you're saying there's a weather effect.
So Andrew, bottom line, what are you expecting on Friday? What do you think we see?
So we think we're going to see a continuation of the trends. And what the trends have been is a slowdown in payrolls employment, the establishment survey. So the number of jobs created, we think will come in 125,000, so similar to where it came in last month, which was a big slowdown from where we had been. On the unemployment rate, we're at 4.25%, and it rounds up to 4.3. We think we're going to get another 4.3, but it's really going to be pivotal for the Fed where exactly that number comes in.
And just to be clear here, your 125,000 is about 40,000 below where consensus sits right now.
So we're below consensus on the number of jobs that are created, and we're above consensus. There's some 4.2s, there's some 4.3s, but the consensus is for 4.2% unemployment rate, which I think is what you were talking about, where people expect that some of these weather effects will come out and bring that unemployment.
So I guess how would you characterize the job market right now? And do you think that broadly the market and your economics peers perhaps are in denial about the state of the job market?
So the problem isn't really where the job market is right now. 4.3% unemployment rate is not too high, and job growth until very recently has been pretty robust. It's really where it's going, and we see that in a number of signals, and we're going to get one of those reports out this week. We get the JOLTS report this week also, and the JOLTS report gives us the hiring rate. And that's really interesting because what we've seen in this job market is not that layoffs have picked up a lot, but we've seen the hiring rate that's been declining and declining and declining. And if you looked at that ISM manufacturing report that came out this morning, we had firms in that report saying, our labor costs are high. How do we economize on labor costs? By hiring at a slower rate, by instituting hiring freezes. So it's a strange job market where it was really hard to hire people not that long ago. So I think a lot of firms out there are not in a hurry to start laying people off, but we do see them hiring at a slower rate. And that's the first step of a broader weakening. Eventually probably does turn into layoffs, but we haven't seen that in the data yet.
So given your view of where the labor market is and where it's headed, Andrew, you think that gives the Fed room to cut by that supersized 50?
So I think they have room to cut 50 for 3 reasons. One, because the labor market is loosening, and that would be the appropriate thing to do to counteract that, but also because inflation has slowed, and because the level of policy rates is up above 5%. And we heard that from Chair Powell at Jackson Hole, where he said there's ample room to adjust policy. And what he means by that is policy rates are high, they can come down, and now there's a reason to bring them down.
So if there is a half-point cut, does that sort of give the little jolt perhaps that the economy needs, and or conversely bring us down to a more normal rate quickly enough? does that do the job, and then they can kind of go quarter point from here?
Yeah, they may get back there. That's the ideal situation. That's what they would be trying to achieve. Unfortunately, the lesson of history is once you realize you need to do that 50 basis point cut, usually you really should have been doing that 50 basis point cut earlier. And remember that jobs report for July came out just after the FOMC meeting. So if the Fed had known that number at the last FOMC meeting, they probably would have cut then. So there is a sense in which the Fed may be falling behind here.
Let's say, Andrew, they cut, your call's right, they cut by 50. What does the pace of cuts look like after that?
So it depends on how the data plays out from there. If the unemployment rate continues to rise, well, they would come to the next FOMC meeting in November and say, well, why wouldn't we cut 50 again? We're still above any kind of concept of the neutral rate. We should be bringing rates quickly down towards neutral. Now, if that unemployment rate rise starts to slow down, they get closer to the neutral rate, then they could slow down and they could start cutting at a slower rate. But we're thinking that they could cut 50 not only in September, but again in November.
Andrew, so great to have you on the show today. Thank you. Thank you for walking us through it. Appreciate it. Now let's get to some calls of the day here. Morgan Stanley lowering its price target on Alphabet from 205 to 190. The note citing Google's legal issues after being found liable of maintaining a monopoly. So this is Morgan Stanley's Brian Nowak talks about the uncertainty related to antitrust concerns. Here's the money line. I think Julie says we may not know the final outcome for 2 to 3 years, maybe longer. He says this long-term uncertainty, in our view, is likely to put a narrow and lower band on Google's multiple. Think 17 to 20 times EPS. He says we would trade Google in these ranges.
It's so interesting here. He doesn't think there's going to be a breakup. He doesn't think that is the so-called remedy that the government will ask for. But he has this sort of interactive screen that you can use. But there's a wide range of outcomes, so wide, in fact, which he acknowledges they're wide. So you're looking at the effects on earnings before interest and taxes between a 15% gain for Google's EBIT to a 23% decline. So that's the range of outcomes that he's considering. So that puts a good sort of framework on the uncertainty or color to the uncertainty that he's describing. Like, that is indeed a lot of uncertainty if the breadth of range is that wide.
You know, it's interesting. There are others, just for a different take here. Brent Till over at Jefferies, friend of the show, recently wrote about the issue, and the title of his note to clients, Julie, more bark than bite. That's how Brent put it.
We'll see who's right.
We'll see.
All right, coming up, shares of Nvidia sinking. How should you be positioned in the chip sector? The Yahoo Finance Investor Playbook coming right up on the other side.
Chip stocks among the biggest losers on Wall Street today, and it comes as the Semiconductor Industry Association announcing that global semiconductor sales hit $51.3 billion during the month of July. That's an 18.7% increase year over year. And joining us now is Yahoo Finance's tech editor Dan Howley. Dan.
That's right, Josh. We're seeing this increase kind of as the world of PCs and smartphones kind of starts to return to some sense of normalcy after we saw the dips following the explosive sales that occurred during the pandemic at the very start, where people went out, started buying new laptops, new smartphones. What else were you going to do when you were stuck inside? It's been 4 years since then. A lot of those devices are starting to age out. Smartphones, people hold on to them between 3 and 4 years now. Same thing with laptops, especially if you got a lower end laptop or an entry level laptop. They're not going to be running that well 4 years on. And so we're seeing more people go ahead and purchase newer ones. And there's a few that are starting to come to mind. Intel is about to roll out, or they just announced their latest chip. Qualcomm announced their own laptop chip that's going into Windows systems. AMD has a new chip. There's this kind of sense of excitement around the AI PC, around AI smartphones. What exactly that means, we don't really know yet, and if people actually want them. But there's a sense of excitement from companies, and so that's really kind of what's going on here with this kind of rise in sales. And then obviously, you can't talk about chips without talking about AI and Nvidia, and so that's also another kind of boost where the huge hyperscalers are buying boatloads of those kinds of chips and setting them up in data centers.
So take a step back and give us more details on those new chips that you were just talking about, the latest sort of in the chip competition here, Intel, Qualcomm with some of those new chips.
So Intel came out with its new chip. It's the Core Ultra 200V. Snappy name, I know, very snappy. But they call it the second generation Core Ultra line. And so just to give you a little rewind, they had the Core I line of chips like forever and a day. Last year they announced the Core Ultra series. That was supposed to be their big splash into AI PCs. Not really. They didn't have enough of the firepower that they needed to be considered Microsoft Copilot Plus PCs, which yet another naming fiasco. And now they have this second generation Core Ultra chips. And so they say that these offer the kind of battery life and power that you would expect from a modern computer. Now, Apple's been doing this, these little guys right here, for years. They've been installing their own chips in there, crushing it with battery life, crushing it with power. Intel just couldn't keep up. That was just because Apple ditched Intel and said, we're going to do this all on our own. We have our own designs. We'll get the chips. That's that. Qualcomm came in earlier this year and said, well, I mean, we're mobile too. Apple's doing this based on mobile chip designs. Why can't we do that? So they started doing that. Now they have their own chips with beating Intel as far as battery life and things along those lines. AMD's been doing the same kind of thing, and now Intel is finally saying, okay, got the message. We're going all in on battery life, all in on performance per watt. That means you should be able to run this all day long and get decent power out of it. They are going to be AI PCs. There's this thing called TOPS. It's trillions of operations per second. It's basically a way for them to measure AI performance. It's kind of hit or miss, though. They take a couple of swipes at Qualcomm specifically and AMD specifically. They also really smack around Qualcomm for not being able to run certain apps just because they're running classic versions of Windows with x86 processing. Qualcomm isn't. So there's some games that you can't run on a Qualcomm PC, and that's a big selling point for a lot of people.
Right. Well, we'll see what ends up happening. Obviously, Intel needs some juice right now.
Man, they really do.
All right.
Wow.
Dan Howley, thanks. Appreciate it. Well, while chip giants like Nvidia have boosted markets over the last couple of years, today the opposite is true. Nvidia is falling over 9%, dragging other semiconductor stocks down along with it. So where can an investor find value in the chip space? With just a few minutes left until the closing bell on Wall Street, we're looking at how to play tech and chip stocks with the Yahoo Finance Playbook. Joining us now is Corey Johnson, the Futurum Group Chief Market Strategist. Corey, it's great to see you, as always. So it has been an interesting day, an interesting week or so, an interesting couple of years in the chip space.
This day has been an interesting week if you're long semiconductor stocks.
I guess so. I mean, we've seen Nvidia obviously pull back a lot, and we've seen sort of the question become, what now? So I guess, Corey, let's start there. What now? What should investors be now considering at this phase?
Well, I think we got to take it in terms of the long-term step away from what the market is doing today and think about what this means for the long term. What we've seen happen over the course of the last few weeks and months, but really weeks, since Jackson Hole, it is so clear that the Fed is going to start cutting, not just cut once. There are predictions as much as 8 cuts next year, which seems like a lot to me. But and I could explain why if you care. But more importantly, I think what it means is a move away from the Magnificent Seven that have carried the market thus far, and maybe looking at other companies that might do better in smaller and mid-cap regions. Well, you certainly see that in the performance, even within technology, which is more my purview, where you're looking at the smaller and mid-cap stocks. While those are also down in technology, they're only down about half as much in the last week as those big monsters that have really dominated the market. So we also see in terms of the numbers that if Nvidia is going to sell off a lot, the market's going to sell off. Just it's the way the math works. But I think more generally, you see investors looking at small and medium cap. They've got a thesis that AI matters. They've got a thesis, as you guys were just discussing, that there's going to be a lot more semiconductor sales in some new arenas than we've seen recently. But if you're not going to own the biggest companies, maybe there are ways to play that thesis. I hate to talk about the stock market in terms of play, but ways to apply that thesis to other stocks that aren't just 7 names.
Are there certain small to mid cap names, Corey, you call out that would be sort of examples of the trend you're talking about?
Yeah, please do not mistake this for investment advice. You don't pay me enough to get my investment advice, and I like you too much to give you my sometimes errant investment advice. But I notice it in names that I follow. I notice it in names I don't. There's a company that I own called Coherent. Again, this is not a stock advice, but this is a company that makes networking gear that's used in telecom, which has been a lousy sector for a few years, and data centers and AI, which, as you may have heard, has been a pretty good sector for the last year or two. And if you look at the performance of this stock compared to Nvidia, in the last month or so, it's done better. It's kind of an amazing thing. It's up 26% in the last month, at least when I was looking earlier today, whereas Nvidia's up 5% for the month. KLA Tencor doing so much better than the 5 times larger KLA Tencor, not a small company, but doing so much better than Taiwan Semiconductor in the same period of time. And I think that these are not stocks that I own, but these are companies that I follow really closely, and I think they're putting up similar kinds of results, and yet the market is reacting quite differently.
So do you think we're seeing sort of a rotation in some cases from some of the giants to some of these small and mid-cap? Okay.
I think it's exactly what we're seeing here. And I think that the other thing that you're seeing is you're seeing some things shake out, and you're seeing investors try to figure out what it means right now. It's not a popping of a grand bubble, but there are certain stocks that have really taken it on the chin. And let me point out 2 of them. So we SMCI, the Hindenburg report was out last week, and the very next day they announced that they can't file their 10K. We know that they've got a new auditor recently, and who knows what's going on behind the scenes there. But there are tens of millions of dollars of related party transactions involving family members and the wife of the CEO. That's never a good thing. I don't know if we need an academic study to point out that that's a risk factor that tends to underperform the other competitors in the market. And you certainly have seen that stock sell off like crazy. Now, another stock you've seen sell off like crazy is Elastic. I was on the phone with the CEO today, and it's pretty interesting. They're making some changes in their sales structure to respond to big opportunities they've got in AI. Their largest customers are growing at 3 times the rate of their smaller customers, which every business wants. But they hit a speed bump, at least, in the quarter that they just reported, the guidance that they brought down. The stock got hammered. Now, I don't know if Elastic is a stock that's going to go up from here or not, but I know that they reported 18% revenue growth. A lot of the internal metrics of this company look really good, and yet to see the market kind of throwing out the baby in the bathwater right now. So what that says to me is that there's nervousness with investors trying to figure out technology, and indeed some investors new to technology investing, because that's a thing that's happening right now too. And so, where there's the hint of smoke, you see investors assuming fire in technology right now.
Let me get your take on another name we've talked a lot about, Corey, which is Nvidia, which got hit today. I don't know, if that's traders, investors still trying to work through that earnings report, Corey. I don't know if that's just Nvidia getting caught up in a broader rotation, maybe both. Dan Gallagher, though, over the Journal posed a question. I want to get your take on it. He says, how long can top customers keep pouring billions into AI when investors want to see returns on those investments and soon? How would you think about that question, Corey?
If investors wanted to see return on investment soon, I think that would be a great question. What we've seen from technology companies for decades is that investors don't want to see returns on investment soon. They want to see returns on investment. How many years and years and decades did Amazon go without showing an operating profit, let alone net income? And yet investors were patient with the stock generally. Now, it did have at least 190% sell-off in there. But generally speaking, growth investors and tech investors are willing to wait a long time until they see a return on investment. So I don't think that's the right question for these kinds of companies, that they want to see ROI right away. Now, do they want to see ROI? I wish that were true. I wish we lived in a Ben Graham, Charlie Munger, Warren Buffett world. But sometimes we live in the crazy buy, sell world of people who do crazy rapid trading based not on fundamentals at all, but wiggly lines on the screen. And so I don't know that the question really, that anyone's really judging the companies on that. Goldman's raised that issue with a note about 2 months ago that people are still talking about. You've seen those big stocks come off those great valuations. But again, I think I had this, really briefly, but I had this really incredible conversation with a CEO at dinner last week with the CEO of this Fortune 500 tech company. I don't know if we were on the record or off, so I'll assume we were off. But he told me that he was meeting with investors who are running big amounts of money out of New York who've never invested in tech or trying to understand tech for the first time ever. So presumably to me, these are people who are having to respond to the weight of Nvidia in their portfolio or in the numbers that they have to match, and suddenly having to learn things about things like software as a service and semiconductor design. Yep. That means there's new money in the sector. That means the new money is looking more broadly than just the big names. And I think we're going to see a little nervousness in that trade among professional investors, let alone the amateurs.
Corey, always great to have you on the show, my friend. Thanks for joining us.
Thanks, guys. Good to see you.
Tech, a main contributor in today's sell-off, down over 4% thus far. For a deeper dive into the sector, we want to welcome in Sanjay Poonen, the CEO and president of Cohesity, an AI-powered data security and management company backed by Nvidia. Sanjay, it is good to see you. And I actually want to start kind of more broadly, Sanjay, because just so viewers understand, you may be at Cohesity now, but you've had a long, impressive career, SAP, VMware. Curious to get your take, Sanjay. We've gone through earnings season now. We've wrapped it up. As you look across the software landscape, and you saw those reports, Sanjay, you saw the results, what did you make of the software market right now? Broad strokes, generally speaking, Sanjay, how healthy, how strong does it look to you?
Well, thank you, Josh, for having me on your show. I think that in general, we are in an inevitable move towards digital transformation. The wave of cloud, multi-cloud is there to stay, pioneered by Amazon, but Microsoft, Google, Oracle, and there will be private cloud and sovereign clouds. But the top two priorities I see, certainly in enterprise software, is security and AI, cybersecurity and AI. And I think when I reflect on the earnings of this past, kind of couple of weeks, Nvidia, reasonably good. The security companies, even CrowdStrike, that everyone expected the worst from, actually did okay. So I'm very bullish, and I look at every CIO report, most prominently recently from Morgan Stanley. These two priorities, cybersecurity and AI, are at the forefront, not just of CIOs, but CEOs and boardrooms. Things like ransomware and resilience. You think the fallout from the Microsoft CrowdStrike is teaching us a lot about resilience. But AI people are looking for some practical ways in which they can implement that to improve their productivity. And it's happening everywhere. I was recently going to a Burger King, and the entire process of how you order is driven by generative AI. So these are forces that are here to stay over a multi-year time frame.
Given that you mentioned CrowdStrike, Sanjay, given that outage, historic, truly unprecedented, really, what are some of the lessons learned there, in your opinion?
I've talked about this widely in a number of different forums, and I think resilience is the key word. This was a non-malicious attack. It was not really, it was an incident that happened because of quality issues in the CrowdStrike agent, and Microsoft together with CrowdStrike, I think both need to collectively do more to ensure this doesn't happen. But what if it was a malicious attack? I'm sure the bad guys are watching. Look at the way in which just a bug was able to create that much havoc. And for the next time it happens, it will be malicious. We, as an industry, have to ensure we can recover from these types of incidents in a matter of hours. It shouldn't take us days. And I think that has to be key in the way in which we think about, if you look at a lot of the way software updates get done on laptops and endpoints, a lot of it was manual. There's a way of doing lights out management that can be a lot more automated. When it's virtualized, the server endpoints, they're much easier to do, and that's something we have great experience from my years at VMware doing. But I think the combination of Microsoft and everybody that plays at the kernel level, companies like CrowdStrike and SentinelOne and Microsoft's own Defender tools play at that kernel level. If you're going to play at that kernel level, you have to have a very high standard of quality. But then for all of us in the cybersecurity industry, we have to be focused on, and in our case at Cohesity, it's on the data recovery. One of the things we pride ourselves in is the fastest recovery platform. We found a lot of our customers now asking us about how quickly can you recover in cyber recovery, and we're actively helping many of our customers with that.
Final question, Sanjay. I have to ask for you and your team at Cohesity. Is there a chance you have a public offering for you all? And if so, is there a timeline?
Yeah, we announced a couple of weeks ago that we finished our fiscal year, $549 million in revenue, growing 26%, and had just closed out a free cash flow positive review our quarter. And that's the fastest growth of our peer companies in fiscal 24. As you know, we publicly announced this Veritas transaction in February. The intent is to close that transaction and then integrate this. The next step after that is a public offering. But to us, an IPO is always an important milestone. It's not the destination of the journey. We do believe this company has, at our size, and certainly with Veritas will be the biggest in our space, about $2 billion in size. We'll have the scale to do this in a very good way for investors by creating a profitable growth company. One of the lessons we're all learning, if you're going to go public, is you want to create profitable growth.
Sanjay, great to have you. I only wish we had more time. Hope to have you back soon.
Thank you very much, Josh.
Let's do a quick check of the markets here as we're counting down to the closing bell. All three major averages approaching their lows of the session. As we close out the session, we'll get you all the closing stats in just a few moments. Stay with us. There's a closing bell on Wall Street. Now it is market domination overtime. Let's see where the major averages ended the day. Deeply in the red, to make a long story short. In fact, all three major averages having their worst day since August 5th. August 5th is when we had the July jobs report that really sort of scared a lot of market participants, raised a lot of concerns about the state of the job market and what then the Fed would need to do to catch up with a potentially worsening job market. Now that sentiment sort of changed over the course of the month. Now we're coming up on another week when there's a jobs report, so maybe there's a little bit of that concern coming back in. The Dow down 1.5% on the day. The S&P 500 off by 2.1%. And the Nasdaq, the big loser here, down by 3.25%. And really, we saw technology lead the declines in today's session. So especially the chips, but if you look at the Nasdaq 100 here, Nvidia in particular now down 9.5% on the day. And if you look even at the past, let's take a look at the year to date here. We have had a couple of pullbacks here. The most recent, of course, after the company's earnings report, but it did have a pullback earlier in the year that took longer, but it took more off of the stock. So we'll see if now it ends up recovering. But we've seen a lot of the other large cap tech names also go down right along with Nvidia. It wasn't confined to that. Another one worth mentioning is Broadcom. That stock up still year to date, as is Nvidia. Broadcom, though, down 6% on the session. It reports its numbers after the close on Thursday, so that could potentially be another catalyst for the chips. But we do get other jobs numbers this week, including the JOLTS report. A lot for market participants to consider, Josh.
Julie, in early August, markets plummeted, of course, sparking fears of a recession. Now the same thing is happening as September kicks off. So while September is historically a tough month for investors, the question is being asked again, is this another blip on the radar or the start of something more concerning? Joining us now is Will Ryan, Granite Shares founder, CEO. Will, good to see you.
Thank you.
So, listen, we all know, I mean, historically, September, tough month to be long the market, right? And we're kicking off just like that, read everywhere today. What do you think explains the market action today? Well, I mean, was this, revival of growth concerns after you got, some data on U.S. manufacturing? Is it, some anxieties about the Fed? What do you chalk it up to?
I think it's one of these days where it's honestly not that easy to say there's a specific catalyst behind today's movement, other than perhaps lack of liquidity, coming back from the Labor Day weekend. But I think it's a little bit of resurgence of some of the fears, perhaps, that sparked the August 5th sell-off, so a bit of a growth scare. But I think we have to wait till we get more data, particularly the latter half of this week, before we get a clearer picture about that.
And what's your sense of both market sentiment, but also your own view about how this data is going to be? Do you think that some of those fears are going to be realized?
I still don't really think that. I think that the data that we've seen so far, continues to trend towards the Fed narrative of, inflation's moving in the right direction, giving them, room to cut rates. And, maybe if anything, we get, if anything, worse data that will lead to a larger rate cut. But I don't think that will be the case. I think it's...
You don't, because we had an economist on today from Citi who said, he's kind of looking forward to the jobs report on Friday, and said, listen, he thinks it's going to be soft enough to give Jay Powell room to do a supersized 50.
Yeah. I don't think that they will do that, but you never know. I think the jobs report, to me, the jobs numbers, they keep being revised, downwards, and that's sort of an indication of the trend that we've seen in the economy, whereby, the sort of higher earning jobs are the ones that are really, slowing down versus lower earning jobs, which have been accelerating. And I think that trend has been going on for some time, but slowing down.
I want to talk about technology's role in all of this in terms of its role in the market sell-off, right? Because as we were talking about Nvidia's leading declines here, large cap tech leading declines, sentiment there is pretty poor right now, it's seemingly, at least with large cap. Does that continue as well, do you think?
I don't know. My instinct is no. And every time we've seen a dip in Nvidia this year and other larger tech stocks more broadly, we've seen it being pretty aggressively bought back. So there's always this time could be different. But if we just go by what we've seen pretty strong buying, whenever we've seen a dip in the market, particularly in the larger cap tech.
What did you make, Will, because we were talking about it earlier on the show, of the kind of moves we saw in commodities, especially what we're seeing in oil? What is that telling you?
Again, so softer environment, some weaker numbers coming out of China in particular. OPEC Plus already been on record as saying that they're going to start increasing production at the October meeting. So all of that sort of sends a softer signal, and oil obviously wiped out now gains for the year, so pretty much flat now for the year.
You guys have some single stock ETFs, which has kind of been a new trend, if you will. You have one for Nvidia. How do they trade sort of relative to the underlying stock?
So in terms of the single stock ETFs, they're typically leveraged against the underlying. So in the case of NVDL, which is 2x Nvidia, that's 2 times the return of Nvidia over a given day. Or if it's NVD, which is its sort of sister product, if you will, that's minus 2x. So on a day like today, it'd be a very strong day for the short, the 2x short NVD, but a very bad day for NVDL, which is 2x long or 2x leveraged Nvidia.
And what kind of activity have you been seeing in that one in particular?
We see a lot
in those two, I should say.
Yeah, I mean, there's kind of why I was saying that so far the trend this year has been people have aggressively bought the market, and so we've definitely seen an increase in activity in NVD, which is the 2x short, but it's still from a absolute size perspective remains small compared to the buying that we see on NVDL. And so it tells me that people are still very much looking to buy NVIDIA on the dip, but there is an increasing cohort of investors willing to perhaps hedge or go directionally short.
What are your Will, are you still just a broader AI story? Would you be a believer in that, even after an earnings season where there seemed to be some more skepticism from investors?
Yeah, look, I mean, to me, this is still the biggest story in investing right now. And, it's one of these funny ones where NVIDIA posts another just phenomenal quarter. For any other company out there in the market, this would be an absolute,
solid report, solid guide.
Yeah, absolutely amazing. 70% margins. Growth exploding over 100% year on year, $50 billion buyback, amazing news. But I think it's just hit in a sort of slightly weird time where we're almost priced to perfection and we're looking for that just tiny detail that maybe signals that the AI sort of revolution is not quite what everybody sort of thought it might be. But I'm 100% firmly believe that this is a story that goes on for a number of years, that there's $1 trillion worth of CapEx that's going to be spent in AI. It's just happening everywhere. And people are sort of, we're early in this, and people are looking for these sort of transformational stories right now. And remember, it took a long time for, even traditional commerce to be, digitalized, and it took many years for that to happen. And so the same thing will happen with AI.
You got to be patient, I guess. A little bit. All right. Well, Thank you. Appreciate it.
Thank you.
Well, nearly 2 months to go until Election Day. Kamala Harris and Donald Trump keep kicking off their campaigns and kicking them into high gear as they ready for the presidential debate. But some of their most prominent presidential campaign pitches may be too far out of reach. Yahoo Finance's senior columnist Rick Newman joins us now with more. Now, Rick, we always know that what we hear on the campaign trail is not actually what is going to come to fruition. And luckily, you've gone through and sort of handicapped some of these campaign promises. Where do you want to start here?
Yeah, this drives me crazy in the home stretch of every campaign season because the candidates go around saying stuff that there's no way it's likely to happen. But, voters listen and they think, wow, sounds like that'd be really cool. So I think one place to start this year is with tax policy. I mean, we are definitely going to see some tax changes, and there's a forcing function here, which is that all of the 2017 tax cuts for individuals expire at the end of 25. So we are going to have a major tax bill, but some of the things the candidates are proposing, I just think have no chance of getting in there. For example, Donald Trump says he wants to eliminate the federal income tax on Social Security payments. Well, that would cost about $170 billion per year in lost revenue to the government, and it could actually make Social Security less stable by just making the budget outlook worse than it already is, and that's not something that I think really has any support on Capitol Hill. Kamala Harris and Donald Trump both now say they want to eliminate taxes on tips. I don't think there's any chance of that happening. Only about 2% of American workers earn tip income. And why them? I mean, what about the other 98%? Why would you just target that? Again, that's not something that's really popular on Capitol Hill.
In your opinion, was that purely a play for Nevada?
Yes. Yep. That's the end of story there. 350,000 hospitality workers in Nevada, most of them getting tip income. That's the high. They have the highest percentage of workers earning tip income in the country, and it's just going after their votes. And that's one of those things you're just never going to hear about it again. I also think Kamala Harris's $25,000 subsidy for first-time home buyers, there's no chance that it's going to happen, because any economist will tell you the main beneficiary of that is not going to be the buyer, it's going to be the seller, because that $25,000 is going to make demand stronger and push up the cost of houses even more, which is already a problem. So examples of some of the things that voters are hearing that are never going to happen.
Unrealized capital gains have gotten a lot of attention, particularly among people like us who talk about this stuff. Is that have any chance?
No, again, I don't think so. This is better known as a wealth tax, which Bernie Sanders and Elizabeth Warren are the biggest supporters of. It's not. So this is you have assets that have a value. You haven't sold them and actually gotten the capital gain. The assets, call it, it could be a stock, it could be a painting. It has a value, and the idea is that you would try to figure out a way to tax the value of that thing every year. It's possible. I mean, legal experts vary on this. It's possible, though, that is unconstitutional. You cannot do a wealth tax. It would violate the Constitution. And just the question of whether it's constitutional is a guarantee that there would be legal challenges that would drag on for years. So let's say Congress implemented this. Let's say the Treasury and the IRS started collecting that money, and then 4, 5, 7 years later, it gets to the Supreme Court, and the Supreme Court says, oh, it's unconstitutional. I mean, look at the budget nightmare you've got on your hands. Then you have to give back all this money. We already have taxes on the books that work, and we know they are constitutional. So if you want to raise more money from somebody, the wealthy or whoever, just use the taxes we already have.
What about, I got to end here with the other Harris policy, raising the corporate tax to 28%. Give me the odds on that one.
Short history here, it was 35%. Donald Trump lowered it down to 21%, and Joe Biden favored raising it back up to 28% to raise more revenue. Kamala Harris wants to do the same thing. Joe Biden could not get that done when Democrats controlled both the House and the Senate during his first 2 terms. He tried. It was in the Build Back Better program that we've all forgotten about. So Biden couldn't get it done. Biden is a master legislator. And to me, if Joe Biden couldn't get it when his party controlled Congress, I do not see how in the world Kamala Harris could get it.
Rick, always love having you on the show. Thanks for joining us.
Bye, guys.
Coming up, it's What to Watch For Wednesday. We're going to get you set with everything you need to know to kickstart your trading day. Stick around, more market domination over time. Coming up.
A company called Open has launched a VC index in partnership with the New York Stock Exchange. The fund is called the NYSE Open Venture Capital Unicorn Index. It gives insight into where these private companies are valued on a daily basis. And for more, bringing in the creator of the index, David Shapiro. He's co-founder and CEO of Open. Thanks for being here.
Thanks for having me.
So we are always in the press, and people who follow these private companies, we always want to know how much they're worth at any given moment. So how do you and your company figure out how much they're worth and then create this index based on that?
So that was the real challenge in creating an institutional grade index that affords retail investors, institutional folks alike, access, affordability, and ultimately trusted insights into these private companies. Now, there are folks who've been trying to create indices out there who rely primarily on fundraising data. And they'll say something like, hey, a large company raised a big round a few years ago. Let's do some financial analysis and figure out where public comps would have that company if it were to be priced today. We took a different approach, and what we've done is worked with ICE, the NYSE's parent company, to create a methodology that incorporates real secondary transaction data. So we understand where these companies are trading in the secondary on a daily basis, and using that significant breadth of data can actually price them on a daily basis.
What happens when a unicorn goes public, David? Then what happens with the index?
So our index is designed with investability in mind, right? There is a real goal to eventually create products that a retail investor might be able to use to get exposure to these hard to access unicorns. And so when a company IPOs, we actually will hold it in the index for 180 days to mimic the kind of lockup period that you'd be subject to if you were an institutional grade holder in that private company.
And as you say, right now, institutions will potentially have access to the information in this. Eventually, is the plan to ETFize this? I guess everything has become an ETF now.
That's right. We believe in the trend of passive management, and our goal eventually is to launch listed products. You know, it's very important with our partnership with the New York Stock Exchange that we introduce structures to the market that can increase access, but in a robust, reliable, and really trusted way. Right? We don't want to rush something to market that doesn't meet that really stringent criteria. And so stage one is launch this index, make sure the pricing is accurate, trusted. We start giving folks the insights they need to make critical investing decisions, and then eventually launch an ETF.
What's any timeline there, David? I would even rough.
Very rough. I'd say 18 to 24 months.
And I'm also, you talked about the methodology of how you guys are getting this secondary market data. How did you get them to sort of agree? Is it because it's through ICE and you have this partner? Because usually there is not a lot of transparency in that kind of data.
Yeah, usually there isn't. ICE is a big part of it, and I have to say, their partnership has been fantastic from the get-go. It has enabled us to go to the sources of secondary information in the market, whether they be brokers, funds themselves, et cetera, and say, look, we don't want to be a competitor. We want to be almost like a non-mandatory SIP, right? You give us your data, we will help create something in a price that the market can trust, and that has gotten over a lot of competitive barriers where folks who might be worried that if I tell someone else my data from my exchange, it might cannibalize business, to realize, hey, these guys aren't really competing with us on that front. They're really trying to do something formative for the market. And ultimately, when something like this exists and is trusted, it increases transparency and accessibility for everyone, which only helps those very same sources of information.
And David, the index is cap weighted, so your number one is SpaceX?
That is correct.
Yeah. Walk us through some of the other names in that index. I'm just curious.
So SpaceX is obviously, the 800-pound gorilla in the index right now. They're about 16%. Our top five are Stripe, OpenAI, Databricks, and Fanatics after SpaceX. And there's been a big shift actually in the last year toward AI. You had folks just on the show immediately prior that were talking about public markets today and the kind of the reaction to Nvidia, et cetera. We have seen over really the last 12 months a big shift into investors really wanting to move into anything that AI is touching. And so those have been significant performers in the index. OpenAI up 30% year over year, and actually the index broadly up almost 24% year over year, largely because of AI. But SpaceX and I guess transportation logistics still number one.
And finally, you're a young guy, if I can venture to say. How did you come up with this? How did this come to be?
A lot of work. Initially we wanted to figure out a way with ICE and ultimately the NYSE to open up asset classes that had traditionally been locked out from retail engagement and non-traditional investors to those folks. And we thought, how do we do that in a way that they fundamentally understand? And kind of harking back to passive management growing more and more important, we realized index funds and indices that are trusted by the market with robust institutional grade and ultimately regulatorily compliant pricing are the steps you gotta get through to really introduce product to that cohort. And so we really spent the last 2.5 years doing just that, and we're excited to launch.
Cool.
David, thanks so much for joining us today. That was great.
Absolutely.
Appreciate it.
Thank you.
Time now for what to watch Wednesday, September 4th. New JOLTS data for July. That's the job openings and labor turnover survey is coming out in the morning. Economists forecasting that number to tick down slightly to 8.1 million. That number coming ahead, of course, of Friday's full jobs report. JOLTS report giving us more insight into the overall strength of the labor market and a hiring rate that's been steadily declining. The new numbers providing a key piece of economic data as we approach the Fed's interest rate decision in September.
Moving over to autos, we'll be getting U.S. vehicle sales data for August tomorrow. Those numbers expect to go down to 15.4 million in the month of August, and it comes after auto sales rebounded in July to 15.8 million, following a major cyber attack that stalled June purchases.
And finally, we'll get another batch of earnings, including Dick's Sporting Goods, Dollar Tree, and C3AI. Dollar Tree reporting second quarter results before the opening bell. Analysts expecting sales to grow modestly in Q2, this coming after rival Dollar General posted a disappointing quarter last week, with shares losing nearly a third of their value after the report.
Excited for JOLTS. All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Markets kicking off a new month with a sharp decline. The S&P 500 posting its biggest one-day decline since the August 5th market shock. And September is historically the worst month for stocks, so this could be a warning sign for investors. Plus, business issues hitting the campaign trail. Vice President Kamala Harris weighing in on the U.S. Steel takeover by Japan's Nippon Steel, saying U.S. Steel should stay American-owned. But we're taking a closer look at why that outcome could be worse for American workers. And the reviews are in for Google's foldable phone, the Pixel 9, what you should know about the device and whether you might want to consider making the jump. From taxes and tariffs to trade, issues facing corporate America are front and center in the race for the White House. One company in focus on the campaign trail, McDonald's. Yahoo Finance's Washington correspondent Ben Werschel joins me now with more. Ben, so a point of your piece, which is a great one, is we see Harris and Trump now talking a whole lot about the golden arches. Does it matter, Ben?
Well, I think it definitely matters for the campaign. I'm taking to calling it the McDonald's primary that's going on right now. And a couple stats to throw at you to kind of set this up, which I think shows why they're reaching out to McDonald's. 9 in 10 Americans, according to the company, eat at McDonald's once a year. So it's a very familiar brand, which everybody knows. And even more than that, 1 in 8 Americans has worked at McDonald's at some point in their life. And that's what Kamala Harris is picking up on, because she's talked for the last 2 years about how she worked at McDonald's this summer when she was in college. She worked apparently at an Oakland chain, at an Oakland branch there. And she's been talking about that recently in speeches and in at least one campaign ad. And Trump, who, as we all know, isn't shy about being photographed at McDonald's, is pushing back on that. So there's been a lot of back and forth there. And it definitely matters to get to your question for the campaign, because they're trying to kind of show they're relatable and show their appeal to as many people as they can. As for the company's bottom line, there's a lot less there. There's a bunch of issues that McDonald's is in the middle of, minimum wage, unionization efforts that could become important in 2025. But a lot of this is kind of campaign theatrics at the moment.
So I guess that you kind of going where I wanted to, Ben. I was curious how you think this ultimately affects or impacts, if at all, McDonald's. Do we have a beat on that? Can we look at history for any kind of guide?
Yeah, I mean, I think the big issue for McDonald's right now is minimum wage efforts. There was a bill that was passed and signed in California and went into effect this year to make the minimum wage for fast food workers $20 across California. That's a big deal for the company. They've been very vocal about that. And there's efforts in other states to adopt a similar idea. One detail I uncovered in the story was that McDonald's donated to a bunch of legislators in Oregon at the state level, in Oregon and Illinois. And not coincidentally, those are 2 states that are considering similar laws. So that's really the kind of front and center issue for McDonald's at the moment. Harris has spoken about this in the past. She wants to raise the minimum wage for everyone and has talked about McDonald's specifically. But a lot of their efforts politically, or at least at the state level, and that could impact their bottom line. You know, whether Harris or Trump gets votes off of McDonald's is less matter for them. And McDonald's has been through this for years and years. I went back to sort of old Bill Clinton stuff for the story as well, that, you know, he's been going to McDonald's for a long time, or at least used to. So they've been in the spotlight for a long time, but there's a few issues that matter for them.
And Ben, I'm just curious, when it comes to federal lobbying issues, how active is McDonald's?
Yeah, so far this year they've been kind of at a similar level of recent years. It's $1.4 million so far this year, which is about on pace for them. They're involved with Congress, obviously, but also the National Labor Relations Board. There's proposals there that could change, you know, their unionization efforts, how franchises operate and things like that. And the minimum wage is obviously a big issue in Washington, although that's been spent at $7.25 an hour, the federal minimum wage, for a long time. So there's lots of issues they're involved with there. A lot of them, none of them are sort of right on the front burner at the moment as much as these state level issues.
Ben, great to have you on the show. Thanks so much for joining us.
Thanks for having me.
Coming up, the reviews are in for Google Pixel 9. I'm going to speak to a product manager from the tech giant on the other side. More Ask for a Trend still to come.
A jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
While it doesn't seem like Kamala Harris and Donald Trump can agree on much, there is one issue where both sides see eye to eye. U.S. steel should not be foreign owned. Former President Trump has voiced his disapproval of the deal in the past, and Vice President Harris came out against Nippon Steel takeover of U.S. Steel at a campaign stop in Pittsburgh on Monday, saying U.S. Steel is a historic American company and it is vital for our nation to maintain strong American steel companies. But is opposition actually the right move for the company itself? Well, joining us now is Al Root, Barron's associate editor. Al, it's great to see you as always. So Kamala Harris comes out swinging here, Al, says no, Nippon should not be taking over U.S. Steel, really mirroring what we heard from Biden and Trump. I like the headline of your article here, Al. U.S. Steel takeover, a victim of good politics, bad business. Walk us through what you mean by that.
Well, listen, we've been very consistent. To some extent, the government should let market decide this. There's no market share considerations. It's basically all politics. And she made those remarks in Pittsburgh, right? Pennsylvania is going to be a swing state. It's a toss-up right now. When I checked this morning for that story, we're talking 49-49. 19 electoral college votes could swing the entire election. So they're basically lobbying for, 50 to 60,000 United Steelworker votes in Pennsylvania. I mean, it would be nice to say, there's reasons that this makes sense. No, it's all politics. You should just call it what it is. They're very focused on not letting either candidate gain an upper hand in Pennsylvania. So, why is this good sense? Nippon is the fourth largest steel company in the world, leading technology, much better capitalized, more free cash flow. U.S. Steel 10 years ago was about the 14th largest steel company in the world. Today, it's more like the 25th largest steel company in the world. It is very hard in a mature commodity business, if you're not growing, to get access to capital. This deal is a good deal for the health of United States Steel. It's not going to happen in all likelihood because it's named United States Steel. If this thing was called Three Rivers Steel, as I've said in the past, nobody would care.
Let me ask you, Al, so let's say, though, it doesn't happen. What, in fact, would be next for U.S. Steel?
Well, so if you remember, Cleveland Cliffs was going to buy U.S. Steel. That was the first bid, and they basically had a go shop provision. And Nippon said, hey, Cleveland Cliffs is going to pay, I believe it was around $45 in cash and stock. We'll pay $55 in all cash. Great for shareholders. We committed to invest $2.7 billion in the assets in the U.S. It's going to be great. And then the politicians got involved. So what's next? Cleveland Cliffs might be off the table. They bought Stelco, a Canadian steel company, in the meantime. Nucor and Steel Dynamics, the other two large U.S. producers, aren't really in the market for unionized steel mills. So you're basically left on a standalone basis. And anyone, including the United Steelworkers, who say, like, well, what's next, should consider, where am I going to get that $2.7 billion that was going to come into the U.S. to improve my operations? That's years of free cash flow for U.S. Steel.
Let me ask you,
it's not, they might be left at the game of musical chairs without a chair.
Al, let me ask you, I look at the stock chart of this name. I mean, it's down about nearly 30% year to date, Al. Is that, do you think that's mostly just disappointment about this deal not getting done?
Yeah, it's pretty much all deals. So the deal materialized in December, $55. The stock, I think it's fixed to highs about $50.20. So it's still $5 below the deal price. So there's always this, well, are politicians going to let this happen? And then the stock cracked early in the year when Biden and Trump basically said, we don't think this should happen. You also remember John Fetterman said it shouldn't happen. JD Vance said it shouldn't happen. Again, I wish, and we've asked all of them, they don't really want to talk about this. We've asked all of them to sort of back up their opinion with anything economically sensible. No one responds. It really is about politics. So that severe drop was deal fear, and then it's just sort of been bouncing around, call it 36 to 41. Nippon commits money. Oh, great, the stock goes up. Kamala Harris makes a speech, stock goes down.
Al, I want to get you out of here, just switch gears a bit. As a resident expert here on all things Tesla, this Reuters headline, Al, today, Tesla planning to produce a 6-seat variant of the Model Y in China. What did you make of that, Al? You think it's a smart move? Would it boost sales?
So, first of all, it is interesting because a 6-seat variant, probably 2 bucket seats in the back in the third row, because they make a 5-seater and a 7-seater Y in the US. The 7-seater is the lower volume model, but you can buy it's a $2,000 upgrade, certain configurations. They only make the 5-seater in China. So now they're going to make basically a third row SUV in China. Is it a smart move? Sure, it'll boost sales. I think it reflects a couple of things. In China, Tesla sales are about flat year over year. Globally, they're down 7%. I'm sure you've talked about, the need to refresh the product lineup, the need to continue to innovate on the hardware side, not just make everything about autonomous driving. So this is like an example of them trying to boost sales in China. It's a smart move. We're talking about changes at the margin, though. Interest rates coming down, Model 2 or a lower priced EV coming out some point in 2025. Self-driving day, robo-taxi day on October 10th. Those are the big deals for the stock. This is like a nice little deal for the stock,
Al,
if you ask me.
Great to have you on the show. Thanks for coming on.
Thanks, guys.
Well, the reviews are rolling in for Google's Pixel 9 smartphone lineup, the newest phones offering users advanced cameras and AI capabilities with the Pixel 9 Pro Fold, bringing the company's biggest ever display on a phone. For more on the new era of smartphone tech, we have Google product manager George Huang, along with Yahoo Finance's very own tech editor, Dan Howley. Welcome to you both. George, I'll start with you. Maybe George started at just a high level for us. Say you're a viewer, George, and you're watching this right now, and maybe you're actually in the market for a new smartphone. You all just announced, a very splashy new lineup there. Make the case for a new Pixel, George. What would be the competitive advantages and reasons a viewer might want to own one of these?
Yeah, it's a great question. Well, with the latest Pixel 9 devices, we're really excited to bring all the helpfulness of the AI experiences that we have, plus the amazing camera that we're so known for on our latest, most redesigned, redeveloped phones that we feel people will love. Additionally, we offer 7 years of OS updates and security updates, such that you'll have a phone that lasts, and you can feel confident in that.
Yeah, George, I have the Pixel Pro 9 Fold, 9 Pro Fold right here. Obviously, opens and closes. I've been using it for a while now as my primary device, and I got to say, I've used other foldables from other companies, Samsung, the prior Pixel Fold, and this really kind of feels like the first foldable that's more like a normal phone, right? The front screen is a regular size. It's not kind of thin and squished, kind of like the Samsung's Z Fold 6. It's more of a normal size than the original Fold, which is a little squat and wide. I guess, is that kind of the way you guys are thinking about these kinds of phones? Make them as approachable as possible without making them feel all like sci-fi and weird. And then, hey, if you want to watch stuff, you can just pop it open like that, and it's not kind of an overwhelming experience?
Definitely. I think you hit the nail on the head. When we reimagined this phone, when we went back to the drawing board, what we looked at is really how people use these phones. And the phone's a device that you use day in, day out, 100 times per day. And so we didn't want to change that, but we wanted to augment that capability. And so when you have it folded, it's like a Pixel 9 Pro with the same size display and just a little bit more thickness. But when you unfold it, it unfolds into an 8-inch massive display, to serve your entertainment, your productivity, your gaming, your creative needs, to give you that extra leg up.
Yeah, I've been using it to message my friends, draft for fantasy on Yahoo Sports, and also just watching the Mets lose all at the same time. Actually win lately. I'll throw it out for the Mets there. I guess, what are you seeing as far as consumer interest on the side of the foldables? I know we have the regular Pixel line, which is also great. The hardware there, big upgrade. The Pro line looks great with the new edging and the new cameras. But what are you seeing as far as foldables go and the consumer interest and uptake there?
We've noticed that since the original Pixel Fold that people utilize these devices in so many different ways. We were actually, when we developed the original one, I think it was in our head a lot. And so we saw that, oh, well, people would use the camera in a certain way or use productivity in a certain way. But actually, when we got out into the market, and this is something that we built upon with the Pixel 9 Pro Fold, is that people actually are using it in much more ways, multitasking, split screen, using it for both work and play. And so there's a lot of capabilities, plus all the additional foldable features that are only relevant in a form factor like this. Really amazing to see how people kind of capitalize on this type of form factor and do so many things with it.
Yeah, I mean, I got to say, I've been using the outside screen. I was at getting drinks yesterday on a beautiful Labor Day Monday in the city, and just had the White Sox going because I guess the only thing I want to do is watch baseball at this point. I think about the kind of AI features that are in these phones and how those are increasingly being integrated. There's a number of features. There's the new Gemini software that's built directly into this. You have that throughout. I was using the ask about the screen feature where you can ask Gemini what's on your screen. It was able to pull up and tell me that I was watching a ball game. I mean, duh, I know that, I put it on, but it's able to pick that kind of information up. Photos, I took a picture of my cat and asked what it was a photo of. It was able to do that. I guess, how are you seeing AI kind of roll out into consumers now? It's been a year since we had the big announcements kind of go out for smartphones, Samsung having Galaxy AI earlier. Now we're having Gemini built directly into the new Pixel phones. There may or may not be a competitor that's going to launch some new phones next week. How are you seeing consumers use these kinds of capabilities?
Yeah, it's a great question. With the Pixel 9 series, we really we thought about how AI could be used in a phone and really make it useful for all. You can see a lot of that through the different features that that we've launched. Gemini is one that you mentioned. Things like Add Me. Additionally, just some of the camera features as well as the call features. And we realized that bringing this type of helpfulness on kind of all spectrums of the phone is really something that we benefit from because we own the whole stack. I think you might have heard that when we talked about that at our Made by Google event. Really trying to focus on how we can bring that helpfulness and how we can utilize this capability from all the models all the way to the hardware and the silicon, and infuse that within to really bring helpful features to our users.
George, I'm curious what kind of marketing dollars you're going to put behind these new devices. And I asked George because I reached out to the folks at Counterpoint Research, and they tell me Google's Pixel phones accounted for less than 1% of global smartphone shipments last year in the first half of this year. So it seems, George, like you guys got to get the word out about these devices.
Yeah, it's a great point. The thing that we hear from our users, though, is that they're really excited about these phones, and the advancements and the capabilities and the features that we're bringing are really resonating with them. So when we hear that really gives us a lot of motivation to continue to build on and make sure that by word of mouth and by also our capabilities that we share these devices and we really get the information out.
Google's George Wang, thank you so much for joining us. Appreciate it, George.
Thank you so much.
Take a look at shares of Nvidia after hours. The company reportedly getting a subpoena from the Justice Department as part of an escalating antitrust investigation. That's according to Bloomberg. The DOJ also sending subpoenas to third parties, and antitrust officials appear to be concerned that Nvidia is making it harder for its customers to switch suppliers. Dan Howley, we have you here as well. According to Bloomberg, here's how they phrase it, Dan. They say antitrust officials are concerned that Nvidia is making it harder to switch to other suppliers and penalizes buyers that don't exclusively use its AI chips.
Yeah, I mean, this is something that I think has been bubbling under the surface of the huge AI explosion is Nvidia. I mean, the estimates are anywhere between, I think, 80 and 95% of the market for AI chips. That's going to draw some attention, especially with, I mean, 89.5% is wild. And it's a large part of that, to their credit, is that they had invested in this a long time ago. They started building this out.
And how many times have we had folks on the show who say how far ahead Jensen Huang still is because he provides the chips, the software, the networking?
Yeah, and it's that part, the software, that I think is what people are looking at. You know, there's a discussion about how NVIDIA will see which companies are able to take its products now and start implementing them now into the data center. And I think that's something that officials are looking at and saying, you know, is this something that's good? Is it something that's bad? The other thing is the software and the lock-in. So they're building, companies are building on NVIDIA's CUDA software. Is that locking them in, kind of ensuring that they can't necessarily go somewhere else? Because, well, you've already put all your money into building on CUDA. Does that mean you're not going to want to go to AMD, or you're not going to want to go to Intel? So I think those are some of the big questions that these officials have. NVIDIA has said, look, there's nothing to see here. We're just you know, doing good because we invested early, and that's just the name of the game. We put all this money in already, and so now we're reaping the rewards because now people are starting to buy up AI chips. So, you know, I think it's going to take a while for anything along these lines to get here. I mean, we had heard murmurs about Google, you know, years ago, right? And then there was the suit finally came out, and just because they're subpoenaed doesn't mean there's a suit at all. It doesn't mean that there's going to be any kind of complaint. They could just say, oh, okay, everything's good, or they could move forward with something. So it's still very early.
Whether whether this actually, you know, turns into a formal complaint.
Exactly.
Your point is well taken. Dan, thank you. Appreciate it. Coming up, I'll check in on a few stocks that are moving after hours. More asking for a trend on the other side. The Magnificent Seven is no longer outperforming the S&P 500. Yahoo Finance's Julie Hyman joins me now with a closer look.
I mean, we sort of knew this instinctively, right, Josh, that we have been seeing the Magnificent Seven, large cap tech, that has really been falling back. The long-awaited catch-up for the other 493 in the S&P 500 finally seems to be happening for the second month in a row. Kevin Gordon over at Charles Schwab, a friend of the show, pointing that out. So you see this here. This is basically the monthly performance of the Magnificent Seven minus that of the S&P 500. So when you see it down, that means that the Magnificent Seven is underperforming. And that hasn't happened going all the way back to 2023, and certainly hasn't happened consistently with this kind of depth for quite a long time either, as we see that sort of rotation continuing here. So it's interesting to see it sort of laid out in these terms. We earlier talked to Keith Gangle over at Gradient, and he talked about this phenomenon as well and what investors should do about it.
Obviously, we don't like to see the Mag 7 massively underperform, but I think it's wise for people to take a little bit of profits out of their Mag 7 and kind of put in other companies. And I think that's exactly what's going on with the market. And again, they're such a big market cap. They're about 30-some% of the overall S&P 500. So we want those names to perform, but I do think it's wise to take a little bit off, maybe go underweight if that's your benchmark, and kind of put those names in otherwhere.
And by the way, it's not just for the last month. It's happening again today. As we know, in today's session, we saw the Nasdaq 100, not the Mag 7, but the Nasdaq 100 down 3.2%. The S&P 500 down about a full percentage point less than that. So the outperformance of the S&P continuing, Josh.
All right, thank you, Julie. Now let's take a look at what's trending after hours. GitLab surging after reporting a beat on second quarter earnings. The company announcing revenue of $182.6 million and beats analyst estimates of $177.2 million. Software development platform also raising its full year revenue guidance. GitLab CEO and co-founder saying the results show the combination of our end-to-end platform and AI solutions are driving results for our customers by aligning to business goals, providing measurable benefits, and improving security. Last week, remember, Bank of America cut its price target on the stock from 80 to 66, retaining, though, its buy rating. Shares of Zscaler plummeting after hours. That company topping estimates on the top and bottom lines for the fourth quarter, but the IT security company missing the street's expectations on guidance. Zscaler forecasting first quarter earnings per share of 62 to 63 cents. It's lower than estimates of 75 cents. Company also missing on full year adjusted EPS and revenue guidance. That's a wrap on today's Ask You for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.